If stocks are so great, why does anyone own bonds? And if bonds are safer, why do stocks dominate long-term investing? The truth is, stocks and bonds win at different times for different reasons, and knowing when and why can make you a better investor. In this video, we'll look at real historical evidence to show when stocks outperform bonds, when bonds take the lead, and how beginner investors can use both wisely. What stocks and bonds actually are. Let's start simple. Stocks mean you own a piece of a company. You benefit when companies grow, earn profits, and expand. Bonds are loans. You're lending money to a government or company, and they pay you interest. So right away, stocks offer higher potential returns, but more ups and downs. Bonds offer lower returns, but more stability. This difference explains almost everything that comes next. Long-term historical performance. Historically, stocks win over long periods. In the US, stocks have returned about 9 to 10% per year on average. Bonds have returned about 4 to 6% per year. Over 20, 30, or 40 years, that difference is massive. That's why retirement accounts are stock-heavy. Young investors are told to focus on growth. Long-term wealth is mostly built with stocks. But, and this is important, that average hides a lot of short-term pain. When bonds beat stocks, bonds tend to win during bad times. Historically, bonds outperform stocks when the economy enters a recession, stock markets crash, investors panic and seek safety, interest rates are falling. Examples: during major market crashes, during deflationary periods, in years when stocks lose 20 to 40%. In those periods, bonds often lose much less. Stay flat, or even rise. They act as a shock absorber for your portfolio. When stocks dominate, stocks tend to win during economic growth, innovation booms, rising corporate profits, long stable expansion. Historically, bull markets last longer than bear markets. Most stock market gains come in relatively short bursts. Missing those periods can devastate long-term returns. This is why investors who abandon stocks after crashes often fall behind permanently. Stocks reward patience, time, Emotional discipline. The inflation factor. Here's something beginners often overlook. Inflation is the enemy of bonds. Bond payments are usually fixed. Stocks, on the other hand, can raise prices and earnings over time. Historically, stocks have done a much better job keeping up with inflation. Bonds can lose purchasing power during high inflation periods. That's why long-term portfolios usually lean towards stocks, even though they're more volatile. Why most investors need both. This isn't an either-or decision. Most successful investors use both stocks and bonds. Why? Stocks drive growth. Bonds reduce volatility. Together, they smooth out the ride. A balanced portfolio can help you stay invested during crashes, reduce panic selling, improve long-term outcomes, even if returns are slightly lower. The biggest risk isn't volatility, it's quitting. How beginners should think about allocation. A simple rule of thumb. The longer your time horizon, the more stocks you can hold. The closer you are to needing the money, the more bonds matter. For example, a 25-year-old investing for retirement, mostly stocks. A 60-year-old nearing retirement, more bonds. Someone saving for a house in 3 years, bonds and cash matter more. Time matters more than predictions. Final takeaway. Historically, stocks win over long periods. Bonds win during downturns. And the best portfolios usually include both. The goal isn't to pick the winner every year. The goal is to build a portfolio you can stick with through every year. If this helped you understand stocks and bonds more clearly, consider sharing it with someone just starting their investing journey.